four great stablecoin entrepreneurs. We have Guy Young from Athena, Sam from Frax, Jose from PayPal, Nick Van Eck from Agora. Four quite different stablecoin issuers. Obviously, PayPal doesn't just issue stablecoins, they do other stuff too. Should we do one sentence description of what you are building in the stablecoin space, starting with you, Guy?
Sure. Can you hear me? Hey, I'm Guy, founder of Athena. We look very different to the normal fiat stablecoin. We have a crypto collateral which is delta hedged on exchanges, and so that creates a delta neutral position where you can issue what we call a synthetic dollar. We came out to market in February of this year with the quickest growing dollar-based asset to breach $3 billion. And yeah, that's our story.
Hey everyone, I'm Sam, founder of Frax. Frax is the second oldest, I think, major decentralized stablecoin after DAI. One sentence is the decentralized central bank. Frax issues currencies and we stabilize them using smart contracts, and now they're issued on our modular roll-up Fraxstone.
Hi, I'm Jose. I'm with PayPal. What we are doing is taking the PayPal balance that is used by 400 million people worldwide, moving it on chain and using it to build the next generation of payment rails.
I'm Nick. I'm one of the founders of Agora. We're building an institutional-grade, credibly neutral digital dollar, and we share income with all the businesses that we work with.
Awesome. Pumped to start this panel. Sam, we'll start with you. In 2022, you and I, well, you were virtual, you weren't on stage, but you were on stage in a sense. We had a panel days after Luna collapsed. Actually, Do Kwon was meant to be on the panel. He had pulled out. And, nobody's really tried to build Luna since then. So my question is, will there ever be anything like Luna again? What are the prospects for that?
Yeah, I mean, the reason I was on that panel is because Frax totally withstood those downturns, and Frax is one of the most lindy decentralized stablecoins. So I think Luna represented this idea and of this decentralized currency that's stabilized by on-chain forces, on-chain economies. And if people recall, there's Terra Chain, right? And the thing with Frax is the name, actually, for people wondering about the lore, it comes from fractional algorithmic. And the idea with Frax is you cannot build a fully algorithmic stablecoin. It just is not possible. And that's the thesis that we had. You need exogenous collateral, exogenous stability mechanisms, exogenous systems like collateralized debt positions, protocol-owned liquidity, all of these things that have made things like DAI, things like Athena, and other stablecoins actually withstand shocks. And you can have innovative components that we've designed. We've designed things like AMOs, which are algorithmic market operation contracts, and different ways to actually stabilize decentralized stablecoins using algorithmic smart contracts. And so I think that if there is a stablecoin that's able to do it and has been championing that since then, it's definitely Frax, and we're here and we're growing. We have our own chain now and things are looking great.
Guy?
I was going to say, I think directionally Sam's obviously correct, but I think it's actually just a question of scale and size. I actually think a Luna could exist today, but it just could never exist at the size that it did at that time. And the reason for that was really you can think about it as like debt and equity within a business, where in a hypothetical scenario where you have, call it like 100 million outstanding of UST, and let's assume that the government's token for like Luna 2 is at $10 billion. The market makers who are basically keeping the peg there have a very strong incentive to basically ensure that that 100 million stays at $1 if their equity position's at 10 billion. And so at a certain level and size, like the crypto system, market makers, large balance sheets can always step in and defend that peg if they think it makes sense relative to the equity. It's just that the size of Luna got to a stage where not even the biggest balance sheets within crypto could do that. So I agree fully with you at like huge scale, it could never work and it's a bad idea. But as a small like experiment, I think it could exist in a vacuum.
So on that same topic, there's been a lot of maybe controversy in the stablecoin space recently with Maker kind of moving away from their decentralized roots. I mean, in my view, they had not been decentralized for a long time, frankly. But the death knell has come recently. So maybe back to you, Sam, is there a future for a truly decentralized stablecoin, or does that lens not even make sense anymore for stablecoins?
No, I think there not only is, but there has to be a good definition of what a decentralized stablecoin is, right? My view is there's basically two types of stablecoins. One that are fiat and cash equivalent and legally redeemable and regulated and transparent. And then the second one is a digital asset that uses smart contracts to stabilize it. Whether those smart contracts work in different ways, they're CDPs, they're FRAX, AMO smart contracts, and new stability mechanisms, it doesn't matter. But that digital token is not redeemable for cash. There's no bank account. It's a DAO, it's a protocol. There's no actual cash to redeem the digital token because it is decentralized. Sure, some of those smart contracts, they might have MSIGs, whatever, this and that. But the idea is that it's actually similar to the dollar. The dollar is not redeemable for gold. It's not redeemable for the Fed's balance sheet, right? You can't line up at the Federal Reserve and say, hey, I have $1, give me 20 ounces of whatever, this and that. You used to be able to do it with gold. You can't right now anymore, right? And so the way that I see decentralized stablecoins is that they're actually the closest thing to decentralized central bank money, right? And that's why we call FRAX in one sentence the decentralized central bank. It's not redeemable, it's decentralized, it's transparent, and then there's no bank, there's no legal bank that has the cash for it. So I think that is the end vision that has kind of the Bitcoin and Ethereum ethos with stability in mind, and that is the FRAX vision.
Nick or Guy, any view on this? Is there going to be such thing as a decentralized stablecoin, as we've known them historically?
I think the opportunity for decentralized stablecoins is to do things that centralized players can't, right? So be natively yield bearing, take on different collateral positions. Ultimately, I think the larger market is centralized stablecoins because there's a lot more utility with them. You can use them for payments, trading, keep them in your checking account, but I think decentralized stablecoins are definitely here to stay and will be a meaningful portion of the market, probably like 20%, maybe a little bit less over the long term. But I think there's always like a room for those types of products.
Jose, moving to you, PayPal is obviously an established business, and you guys have really aggressively moved into the stablecoin space. So you could sort of argue that PayPal's existing business was stablecoin-like in some respects. How does issuing PYUSD actually augment the business?
Yeah, PayPal has been around for 25 years now, and I would argue on the centralized and non-redeemable and non-centralized are not the same thing. And your point to the dollar is obviously spot on. It's non-redeemable, but it's certainly centralized. If we were pitching PayPal 25 years ago in the context of today, we would argue that the PayPal balance was how would we frame it? A stablecoin in a permission environment, right? It's basically redeemable, you can interact, but you require that is on that both sides of the transaction have a PayPal account. Where we think that this is going next, the way we think about stablecoins, about our stablecoin, is basically tokenized balance. Is the balance that you had that now you can use to interact outside. And the reason we entered the space, the stablecoin was issued about a year ago. We've been in crypto for around 4 years now. The reason that we got into digital assets is because we are in payments. And when you run the fundamentals for payments, moving money through blockchain protocols is 26 times cheaper than moving them on an ACH network. It's 400 times cheaper than moving that through checks. So if you believe that and you're in the payment space and you believe that eventually the low-cost actor wins, you cannot afford not to be in that space. It will take time, and we'll talk about what it's going to take for stablecoins to be adopted for payments. But the universe likes a low-energy state. If you can move money cheaper, money will move cheaper.
So staying with you for a second, I think stablecoins are obviously a huge success story in crypto. There's 20 million north of that monthly active addresses on all blockchains that use a stablecoin. 120 million addresses have a non-zero balance. They settle around $5 trillion a year. The numbers are huge. They're going up and to the right. But also at the same time, I would argue a lot of the infrastructure is very immature to link the fiat world and the stablecoin world, and we're just still stitching it together. What's your assessment of where we are in the maturity process of stablecoins becoming a true global payment system?
I think we are at the beginning of the first inning. So it's super, super, super early. It's really difficult. We all have seen numbers of the number of monthly active accounts and people take discounts or not. Even there, you're talking about wallets. So it's really difficult to translate that to active users. When we think about what are the numbers that we care about, we don't care much about market cap of stablecoins. We care a lot about on-chain volume. We care a lot about monthly active users. The problem is that nobody has a number for monthly active users. I think that sometimes we look at which stablecoins are used or which protocols are used for a stablecoin, and we extrapolate from the number of active wallets to the number of users. And I think that in the future, we will still see a ton of people who, for convenience, are using custodial wallets. And I know how many wallets we have, and I know how many individual users we have. And if we were to extrapolate from that, the numbers from some of the reports that you would see would be totally different. So it's super, super early. On the payments space, there are a few things that we are still lacking. We are lacking. One of the reasons why we deployed compatibility with ENS on our wallets is that we need a frictionless way for people to address payments from one to another. People are just not going to go paste in wallet addresses to make payments. We need the ability for business to hold stablecoins easily, and that is more regulatory than a technology issue. We need integration with ERPs. We need a way to send value back to customers. All those things are not in place yet. And that's why somebody in one of the side events of the conference, I think, was saying yesterday that crypto-funded e-commerce is probably around 8 billion. I don't know if that number is right or not, but it sounds about right in terms of the order of magnitude, and that's still a teeny tiny amount of global e-commerce.
Nick, your view on the extant frictions, what are the barriers that we have to surmount for stablecoins to actually become a globalized payments system?
I think it depends on where you are. Maybe let's just start with usability, right? Today, crypto isn't very usable for most people, right? You have to do multiple clicks, interact with the chain. I think like having seamless user experiences through embedded wallets in a Web 2 type mobile app will help that. In different regions, there's not a strong fiat on and off ramps and liquidity profiles, right? So, for example, if you wanted to sell AUSD, which is our stablecoin, or Pi USD, or even USDC or USDT into 20 million of pesos, there's not that much liquidity for it, right? So that's like a barrier on the liquidity side for taking off in FX markets. So I think usability, ease of on and off ramps, liquidity. These are the main things. I think regulation will come. That's obviously like I think a near-term barrier, but to Jose's point, it's not just like 20x plus cheaper. It's really like, and even 10x better. It's like 1,000x better, right? If you're moving $10 million, or someone like Pepsi that's playing around tens of millions of dollars cross-border on a daily basis, you're either pre-funding accounts, using factoring, forecasting flows. Now, if you want to just send $100 million from Mexico to Singapore, you can see, it's in the mempool, it'll be there in 10 seconds. Like that is a 1,000x better experience. That's why I think, the title of this panel is The Relentless Rise of Stablecoins, Crypto's Killer App. I think today it is the killer app because it is 100x, 1,000x better than moving money cross-border and servicing EM latent dollar demand today. I think a lot of other things like tokenized fund products will come much later because they require a lot more things to get going. But I think a lot of the key things are in place now for stablecoins to take off. They are taking off, and we'll just see, I think, us hit like a $5 trillion asset class in the next 5+ years.
I will note that the title of the panel is actually taken from a Brevin Howard report by Peter Johnson, who's not here. But it is a great report, so definitely read it. So I want to decompose the driver's demand for stablecoins into emerging markets and developed markets. We just published a report on emerging market adoption. I think that's where we see the most traction for stablecoins. I think it's very obvious why an ordinary individual would choose digital dollars if they don't have access to dollars at all, and the backdrop is an inflationary currency. If they don't have access to dollar banking, if they're poorly integrated into the global financial system. It's very clear why in emerging markets you would choose stables. What about in the developed world? What are the prospects for stables to actually be adopted, and what are the types of entities that would choose to adopt stables as opposed to existing sophisticated financial rails. Jose, maybe we'll start with you.
So if you are a consumer mostly who has access to a credit card in the European Union, in North America, what's the need for you for stablecoins for mainstream e-commerce? Truly today, not much. So many of the use cases in the report that you highlighted, crypto trading is going to be there. Access to crypto markets is going to be there. It's going to be in the bigger scheme of things, a relatively narrow use case. Definitely, I do think that stablecoins will dominate that use case. I don't know that it's going to trickle down to mainstream adoption. If you're in the US, currency substitution is not a use case, and yield, there are other options. Where I think that we will see adoption first in the most developed markets are corporate use cases. I think you're going to see that on treasury management, you're going to see that on B2B payments, you're going to see that in vendor payments. For all the things that Nick was saying, it's not only that if you need to move $100 million, it moves in 10 seconds, is that you can settle in a weekend, is that you can get the money moving around instantly. One of the biggest supporters of what we are doing on the PayPal side internally at PayPal is our treasurer. Imagine that you need to move money around to 160 markets or more, and you're getting into that mad rush on Friday at 2 p.m. trying to get treasury everywhere all over the world before the banks shut down. That's a very rational conversation, and this is a place where stablecoins it's incredibly easy to have a conversation with a CFO. So I do think that you will see that first on corporate use cases before you see it in mainstream e-commerce.
And I also think trading firms in developed markets are going to be the primary users of these assets for the exact same reasons, right? Okay, if the market is down over 10% on the weekend because there was some bad action in a foreign country, well, actually you can now move money or shift risk. Whereas in traditional markets, the banks are closed, right? Markets are closed. So I think trading firms are going to be one of the first to take this in developed markets as well.
Sam?
Yeah, so I want to reframe the question a little bit to get to the answer. And so if there's one thing anyone from this kind of talk takes away from this is that money and the economy is not zero sum, and it's actually a positive sum environment. It's not like the law of thermodynamics where for energy can't be created or destroyed, so someone has to take something from someone else. And the important thing about this is everything Frax builds is in terms of growing the liquidity and growing the piece of the pie of the entire ecosystem. And so, for example, actually on Ethereum mainnet, USDE, Athena, and Frax's curve pool is the largest liquid curve pool on curve for Athena and Frax. And same thing with AUSD, the Agora. And so the first thing we decide to do is we try to actually go and create opportunities that increase the liquidity for everyone. And that, I think, is very important because my hot take, honestly, is that in the US and in like mature financial markets, they're never going to actually admit to needing to use crypto. And us trying to go over to the traditional financial market and saying, hey, please, like, try this thing and stuff, is not going to actually work. We will have to continue to build the liquidity in our ecosystem, and they will eventually have to come to us. That's our view at Frax, and our view is anyone that wants to build with us, we're not going to actually like say, oh, Frax is better, this, and then our peg is safer and this and that. We're actually going to try to increase the liquidity for anyone that wants to come on chain and work with us, because I think that is, in the end, the most likely way that we're going to actually have traditional players come on the blockchain and actually make use of all that liquidity.
Yeah, I think Sam's point is right. Is like people try to group together stables as like one similar asset, but this is positive sum. There's a lot of different types of stablecoin products that can actually be quite synergistic. Like, we work with the Frax team, so does Athena. And so I actually think people need to do a better job of defining what kind of stablecoin are we talking about. Is it a fully fiat-backed stable that's probably going to be used for trading, payments, and as digital cash? Or is it a different type of product that can appeal to maybe trading firms that want to use it as collateral, like primarily like Athena? Like, there's a lot of different use cases, but I think this industry can also be positive sum, and many of us can work together with one another. And then I think a lot of traditional market participants will come in and say, okay, it's time to play ball.
So I want to return to something you said, Nick, actually, about settlement on the weekend. So It's one of the frictions and one of the issues in this space is that stablecoins are 24/7, 365. Well, any crypto is. Dollars are banking hours, which there's more not banking hours than there are banking hours. If you want to settle the fiat leg of a trade in or out of stablecoins, that only works during banking hours. In the past, we had Sen and Signet that were kind of bank settlement, interbank settlement, or rather intra-bank settlement systems that helped with stablecoin liquidity outside of those banking hours. Now we don't have those things. So actually, I'm just genuinely curious. I don't know the answer to this question. I know you're not meant to ask a question you don't know the answer to, but are there systems in place now to facilitate dollar liquidity for stablecoin issuers facing redemptions on the weekend?
Yes. Yeah, so there's a few US banks that still have a 24/7 payment network. There's also some that are now popping up in Asia that we're actually planning to work with. One of them is going to go live next month, and I was in their office earlier today. So there's those types of rails, right, where it's like a 24/7 payment bank where you can settle over the weekend. But there's also other things you can do, right? Like have maybe something, we only redeem in another stable over the weekend. If you think you can get better cash there, or you just go to a market maker and say, hey, provide me credit over the weekend for $5 million, and like they'll charge you, 5 bips, 10 bips a day, or whatever it is. But there are ways to do it over the weekend today, and there's also, of course, other means to go about it.
So this isn't like a huge problem then?
It's definitely a huge problem, but you have to solve it, right? It's something that we spend a lot of time focused on because it is one of the biggest risks to the business.
Right.
So it's solvable, but it is challenging, and many banks don't accept crypto-related customers or even new customers. Part of that's because of the choke point operation, which I know you like to heavily detail, which is very much real. And like that's one of our unique advantages is that we work with some of the largest banks because they actually have a relationship with us and VanEck's larger business over time, right? And so they're like, okay, sure, we'll work with you. But in many cases, you don't have banks willing to work with crypto companies at all, much less the few that work with 24/7 payment rails.
I want to change the topic a little bit. Talk about corporate adoption of stablecoins. This is something we've seen in our business. We talk to a lot of these firms that are on the frontier, and they increasingly report to us that there's sort of non-crypto businesses that are now using stablecoins for ordinary transactions. And I'll open this up to the whole panel. Why would you, as the CFO of a mid-sized business, whether here or maybe a market with a less integrated financial system, why would you prefer stablecoins to the typical transactional rails?
Because there's no financial infrastructure in the jurisdiction that you're operating, right? So this is a real anecdote. We were introduced to a commodity business that is based out of Western jurisdiction. They have oil and mining operations in West Africa. There's nowhere for them to keep dollars in the banks there, or they don't trust them. And so they'd much rather use stable coins that have Lindy and are basically money, right? I would say like what we're trying to do is become money, and centralized money is the same with Frax and decentralized money. And so there's a lot of real world businesses that have access to very legitimate banks, but are operating in jurisdictions where the financial services infrastructure isn't there or isn't something they feel comfortable with. And so they'd much rather hold a stable coin that's in their own self-custodied wallet and use that to interact with local contractors or local governments even.
So I'm going to bring back the spicy take again and say, in the West, it's not going to happen super quick because TradFi is going to be like, why would I use this? Why do I need this? There's trusted banks and all this stuff. But if you actually just close your eyes and think in 10 years what the world will look like, if we're right about our thesis that everyone will be using stablecoins, eventually they will have to come groveling in this direction rather than us groveling in the other direction. And so my view, and I know it's a spicy take on this stage, is that I don't even worry about how or why they would want to use stablecoins because I don't even see it as my or our industry's job to educate them on it because they will have to go with the tide eventually or be left behind. And so I know that's a little bit of a spicy take, but so far it looks like it's actually correct because everyone prefers the settlement 24/7, 365 of stablecoins, the ability to custody and have no other custodial trust. And it just seems like, objectively, if you understand this stuff, this is the way that history is going. And the only question is, what is the path dependence, the actual path to actually, in 10 years, everyone getting paid in stablecoins, on-chain, earning yield, and making payments and payment apps using stablecoins, right? That's the only question, is how will it look, not will it look in that way. And so since I'm so confident and we're so confident about that at Frax, the thing we're really just focused on is making sure that everyone else that's building towards that decade-long future is set up to work together in positive sum with the best successful outcome possible.
Yeah, I think the 2 points you touched on there, instant settlement's obvious as a benefit there, but then the other one's around counterparty risk as well. So I think anytime you're layering intermediaries within the real world, you're obviously adding counterparty risk at every level when you're doing that. And essentially when you're using stablecoin, you're collapsing that to a surface area, which is essentially just the issuer who's sitting on the other side, whether it's USDC or one of these guys. I do think one piece to consider here is also you tend to see a bit of inertia with businesses when you have something that's fundamentally competitive to your own business model that exists now, right? So the business model of a stablecoin that's being transferred on-chain looks very different to a payment system that's charging somewhere between 150 to 300 bips on every transaction of the entire internet, right? And so I think there is a real question of, if the entire world is transacting with just stablecoins at sub-cent transactions on-chain, that's an amazing outcome for users and consumers who clearly benefit from those cost savings. But then there's an enormous amount of equity value destruction in the real world that occurs when that sort of version of the world exists. And so I think naturally there's going to be a pushback between transitions from where we are today to that sort of situation I described there.
Yeah, Jose.
What we are hearing from our enterprise clients is repatriation of funds, similar to what you were saying, and treasury management. Interestingly, what we are hearing about our SMBs is not what we were expecting to hear. We thought we were expecting to hear US SMBs who want to pay a way to pay suppliers outside the US instantly and not lose their money for 5 days in the wire transfer labyrinth. We are seeing that. What we were not expecting is actually folks outside the US, smaller companies outside the US, who need to pay suppliers in the US, and they lack access to hard currency in their markets. In many of the international markets, today it's actually easier to get a hold of USD denominated stablecoin than it is to get access to hard currency. And I think that's what is going to drive some of the folks in the US to integrate into ERPs and start accepting stablecoin payments.
So we were having a little argument before the panel about crypto dollarization, which is a made-up term, but I think you can guess what it means. So one of my big theses for the next decade ahead is stablecoins are a more frictionless way for individuals to spontaneously engage in currency substitution, mostly into the dollar, is what we've seen. And we haven't seen a full-fledged dollarization event with stablecoins yet. You could say there have been some portions of certain nations or economies that have dollarized, maybe with stablecoins. Probably Venezuela and Argentina would be the two to call out, and then Nigeria seems to have a significant affinity for stablecoins. What's your view on this? Do you think governments will be able to successfully inhibit this, or are blockchain wallets and blockchain infrastructure, is it so hard to crack down on that you'll see this happen regardless?
I think it's a dangerous proxy to liken stablecoin adoption with USD stablecoin adoption. I do think that currency is going to migrate to digital rails, and I do think that we will see non-USD denominated stablecoins popping up in different countries. I don't think that countries will get dollarized over a stablecoin. I think that dollarization by stealth is something that doesn't really happen. It might happen to some degree, it might happen to a small percentage, but I think there's a regulatory aspect of it in which countries will not relinquish their sovereignty over their own currency and over their own monetary policy. So I don't think we will see that. I might be wrong, but I don't think it will happen. What I do believe is that one of the reasons why you only see USD denominated stablecoins today is because the use cases today are mostly for USD denominated flows. Crypto markets are mostly denominated against USD. Emerging markets want to be able to hold dollarized savings in some way, and that's a USD aspect. When you get into some of the more mainstream parts of the economy, and when you get into some of those cross-border flows that are monetized through FX, if both sides of the transaction are USD forever, there is no FX to be monetized. So you're going to find more resistance from the traditional operators to move digital if the FX spread just vanishes into thin air.
Yeah, it's actually an interesting point. I mean, stablecoins have been 99% dollarized for basically the whole existence. Actually, I ran the numbers recently, and I ran them 4 years ago, and they're more dollarized than they were. It's incredible. I mean, I would have thought the euro would have been somewhere. It's nowhere. What's going on?
So my view on this is, in order to answer it, you kind of have to look at why the dollar itself is useful. Why do other countries or users and people want to save in it? The way that I like to say it is the dollar does actually have a peg. It's CPI, the Consumer Price Index, which is pegged to a standard of living. And the most credible entity in the world that can make that peg commitment is the US government, right? The largest economy in the world. And inflation is just another word for saying how off the peg is, right? If there's 10% inflation and the dollar, if it was a stable coin, it'd be like 90 cents, right? That means it's off peg by that much against the consumer price index. And the reason I think of it in that way is people want access to a certain object that actually keeps their standard of living the same. And actually, you made a really good point that a lot of these things are dollar-denominated flows, but the underlying reason of why are they dollar-denominated flows is that there needs to be some anchor or some price to something that people can keep stable to a standard of living, right? And so other people know that other currencies, clearly other national currencies that inflate more or don't work as well or have smaller economies that can't make that kind of commitment actually aren't as safe. So that's part of the main reason, at least we think at Frax, why the dollar is so important. And if people in the audience have heard Balaji talk, and he spoke earlier today, there's a concept that actually him and I came up with called the flat coin, which is actually a stable coin unit that's pegged directly to CPI without a national index, like a national unit like USD or Euro. My guess and my take is in the next 10 years, that will actually increase in market cap against the dollar, not other national currencies, because the dollar is so good at doing what it does. The only thing that can compete against this is a flat coin, and Frax does have an experimental version of it, but the idea is that that will be, in the next 10 years, one of the most predominant sectors of stablecoin research.
I also think, right, the US dollar is the largest vehicle for global trade. Something that we chatted about earlier is most people don't use stablecoins within the United States because it's relatively easy to move money within the US. And the same is true for the Eurozone. The Euro is the second largest currency used in trade. It's pretty easy to move money within the Eurozone. And so if you don't have the cross-border commerce pull and the money pull that Sam was just talking about, today it's not really, there's no really need for a Euro or a JPY stable. Where I think they'll start to come into the market is when you really start to have FX trade in different stable coins. And there'll be a very much smaller portion of the market than they even are of the trade balance, because I think they'll purely be used in FX markets just for settlement purposes, because most people just want to hold dollars.
So I want to ask one last question before our lightning round, which is another kind of dollarization, which is dollarization of blockchains. So if you look at the data, stablecoins settle about half the value that gets settled on blockchains. The other half is obviously the native crypto assets, right? In the past, it's been as high as 70%. So, and back in 2018, it was basically 0% was, stablecoin settlement. Blockchains themselves have become dollarized. Is this eliminating the usage of, Bitcoin, Ether, as that medium of exchange, the collateral type? Are stablecoins too successful? Are they cannibalizing the usage of the original blockchain tokens for the MOE, unit of account, store of value use cases? Is that something we should actually worry about? Is kind of stablecoins being parasitic on blockchains?
I think it depends which blockchain you're talking about. So Bitcoin and ETH are very different in that regard, where the growth of stablecoins can actually drive value to Ethereum because Ethereum, through MEV and all the activity that's sitting on top of it, can actually capture a return from transfers, trading, and the storage of dollars on it. Bitcoin's obviously not the same. I don't necessarily see that as a threat or like an issue, where I think the story for Bitcoin is sort of, found a more narrow use case of a store of value through time, and that medium of exchange has sort of dropped away. But I do think it is worth just considering that the growth of stablecoins is kind of actually the most valuable thing that Ethereum is providing right now, which is you've only really got two real use cases of blockchains at scale, which is trading and it's using dollars in there, and it's the storage of stablecoins for a store of value. And so if stablecoins didn't exist, I think ETH wouldn't be worth much at all. And part of the value is actually derived by the growth and success of stablecoins.
But I mean, then ETH should be concerned that more stablecoin settlement happens on Tron.
Sure.
Yeah, which is the case today, believe it or not. Anybody else on this question? Yeah.
I like to refer to myself as the world's first self-proclaimed stablecoin maximalist, so you probably know the answer of what I'm about to say. But my point is, I think that this is 100% going to be the case, that stablecoins are going to increase in usage and settlement. However, that doesn't make them a good investment asset for store of value purposes, right? And so that's why everything here, there's like a second token that's a staking token for the Frax ecosystem. For Athena, there's a governance token, staking token. There's Ethereum and Bitcoin that are investment store of value assets. And I think that everything will be settled in stablecoins because that's the unit that, again, anchors to a standard of living. But you would actually be never getting any wealthier if you actually kept your investments in those units, right? So there's totally different use cases.
Agree. I don't think at all that stablecoins are parasitic to blockchains. I think that analogy is moving from bartering to money-based trading. It's not if you have an opinion on one crypto asset going up or down in value. In many cases, you want to have a neutral asset to park the value there. It is not necessarily that you barter between Bitcoin and ETH because those things might be moving in the same direction. So I do think that having a neutral asset in between actually enhances trading, and definitely we are seeing more volume on our trading side since we enabled stablecoins.
Yeah.
Yeah, I don't have much to add. The only thing I'll say is, like, again, it's like if you want a different product, you should buy it, right? Like, people ask us, oh, how do you compete with like a yield-bearing stablecoin? It's like, well, if they want a yield product, they should buy the yield product, right? So I think, yeah, stablecoins will be the means of settlement, but they won't be the be-all, end-all.
Okay, quick lightning round. We have minute 45 here, so be quick. Stablecoin market cap in 5 years. Top stablecoin in 5 years. Maybe it's one that doesn't exist today. Tether market share in 5 years. It's 70% today. Guy?
Somewhere between 3 to 500 billion. I think it's like a reasonable guess for me in the next 5 years. I think this top stablecoin will be Tether, and that continues to be the case. And their market share is probably going to be exactly the same. I think the reason for that is that a lot of the new entrants that are coming to market, whether it's Nick and the other guys on the panel, they're fundamentally sort of attacking USDC's use case within the market, and that to me feels like the more open space for new entrants to come in and attack. So I think Tether's dominance is going to continue compounding into the future.
Sam?
Tether market cap in 5 years in 2029, I'd say over 1.1 trillion. I'd say Frax, hopefully number 3 rank.
Okay.
And I think that there will be a multi-trillion-dollar stablecoin industry.
Jose?
Total market cap, we've been betting on more than 1 trillion. Number one stablecoin for commerce and payments is us. For trading, I don't really care, but we are very focused on the commerce and payments side. Market share, I don't think that anything that is more than 25% of share for any given issue is healthy for the ecosystem. I think that we need more options.
Nick?
I think it'll be 3 trillion in 5 years. I think Tether will be the largest. I think their market share will reduce from 70% to probably 40% today. So I think there's a large chunk of Tether holders that will only ever hold Tether, but I also think there's a large proportion that'll hold other assets. So I think they'll shrink. And then beyond Tether, I think will be the largest institutional grade stable. I think Circle will fall to probably like 3 or 4.
All right, well, that's it. Round of applause for our panelists. Thank you so much.